Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And today we're going to talk about student loan repayment strategy, how to figure out which loans to pay back first. Now that we're in that repayment period, if you're like me and had to finance your own higher education, you have a lot of student loans you have to deal with. We're going to talk about my plan for it and kind of what's important about picking it out.
Two Super Guys Trade Stocks.
So this chart right here is from the Federal Bank of New York. Basically, student loans represent like $1.7 trillion in debt right now. So, as far as non-housing debt in the U.S., it is the largest section thereof. And then even more so, it's kind of an interesting trend that we've obviously observed here since I've been in forbearance. This is the delinquency rates. This is from the same source, the Federal Bank of New York. The red line here is actually student loan debt. Right. So student loans were one of the highest kind of risk, debts for default prior to the pandemic. We got the pandemic, we've got forbearance for the last 3 years basically here. So the actual default rate or delinquency rate fell to almost zero. There was a small portion of private loans. The vast majority of things are held by the federal government, so they were all in forbearance. We have not yet begun to see what's going to result as payments resume. October is the very first time where people are going to have to make a payment on this, like I said, in almost 3 years. Pretty scary.
Can you go back real quick?
Yeah, this one.
The credit card debt is terrifying because when you go in debt on that, you're paying like 20% interest on whatever you're in debt in. That's terrible.
Yeah. Absolutely. There was an article, I'm not talking about it today, but there was an article on CNBC this morning about how credit card defaults are starting to increase. I don't know what the actual numbers are there. Could be 0 last year and then 3 this year, and then it's tripled. What would Dave Ramsey say about credit card debt? About student loan debt. He would say, pay it off, dude. Just pay it off. Doesn't matter. Like, even if you have an actual match on your 401k, he would say you shouldn't be contributing to the 401k at all.
Really?
That's what Dave Ramsey preaches.
He'll
tell you that.
Is there any nuance to that, or is it just
no?
Like the interest number doesn't matter, like the interest rate doesn't matter?
Nope.
Just pay it off.
I don't know how much Dave Ramsey exposure do you have, like as far as you seen him.
Not a lot, because I highly disagree with his snowball method. It makes no sense.
He is a religious zealot of money, and what I mean by that is that there is no other way. There is no consideration. There is no data you can show him. He has his way or the highway, and his interpretation of data is sometimes a little subject to variability that people don't agree with. He has his fan base that absolutely is devoted to him, but there's a lot more nuance to it if you actually want to adhere to best financial practices, if you will. So I tend to skew more towards these guys. Have you seen these guys before? The money guys?
I've heard of them.
Okay. So they are both financial advisors, and they're much more, I would say, data-driven in terms of real-world best-case scenario outcomes in their approach to things. And they would say, sure, you can still contribute to your 401k up to the match. And then after that, you can kind of pay toward your student loans. They'll even talk a little bit about loan arbitrage. Now, loan arbitrage basically is you're capturing the spread. So say I have a loan at 4% and I'm earning 10% of that money. I'm earning 6% in between. It's never that simple, because you would really have to do a risk-adjusted rate of return in order to compare apples to apples, because paying off the debt early at 4% is a very locked-in, safe, secure return versus 10%, say, in the stock market is a very it could be maybe probably on average kind of rate of return. So you have to compare them apples to apples, which would be a risk-adjusted rate of return.
Okay.
They have their financial orders of operation. This is kind of like Dave Ramsey's, baby steps. This is their kind of version of it. But, if you look at the process here, one of the real questions is what makes high interest debt versus low interest debt? Because there are very different stages in this, step 3 versus step 9 in their order of operations. Obviously credit card debt, like you were talking about how aggressive the interest rates there are. There's no way, you can't count on making 20% on the stock market every year. And your credit card debt is definitely 20% plus, for the most part, unless you're doing some other weird stuff when you got 0% periods. The other thing that kind of ties in here is how risky should it be in life. Have you ever seen like this or heard of what the glide path is and that sort of thing with airplanes before?
No.
No. All right. So this is kind of the slow down descent that the airplane takes to come in and land at the end of the runway. Right? It's like a 3% angle is what actually their target is, and they have lights down here indicating where they are, and they can the computer system and those antennas can actually communicate and tell the plane if it's on the appropriate glide path. But the basic reason why I mentioned it here is that theoretically in life, as you age, you should be less and less risk tolerant, right? Does that kind of make sense to you?
Yes, you can definitely
Yeah,
afford to have more risk when you're younger because you can make up for it with different planning.
exactly. So like I said, this is back to comparing the rate of return. This is the stock market, 10% on average. We kind of both know that intuitively. The whole idea behind here is that risk adjusted rate of return, like I was kind of mentioning. All right, I'm going to circle back to the airplane thing here in a second. The idea being that should be paid more for higher risk. You want to have that combination there where you're going to be comparing apples to apples in terms of risk adjusted rate of return. All right.
Okay.
Still with me?
Yes.
Yeah. So this is their idea of a glide slope
Oh.
representing that risk adjusted rate of return. This is the very, very basic about what interest rates should be attacked when it comes to student loan interest. If your loans are over 6% in your 20s, pay them off. Your 30 is 5% should be the cutoff number, and then 40 is 4%. That is a very
I
basic guideline for how aggressive you should be in eliminating student loans, according to the money guys. What do you think about that?
so I mean overall it's a better rule than Dave Ramsey. One thing I will say is you can look at I mean, a projection is what it is. It's an estimate. You can't ever rely on an estimate. But
Yeah.
let's say you have a 5% loan and you're 27, right? The stock market is not projected to be super hot for a little bit just because of how much we've gone up and how fast for at least 4 or 5 years. I would
Mm-hmm.
probably pay that off. Granted, once you start doing that, you start adding a lot more nuance to everything.
Yeah.
So it's not as hard, fast rule. So,
Yeah. There's that great chart. I don't have it in this presentation, but it correlates the current PE of the S&P 500 with the anticipated 10-year average rate of return.
yeah.
That is something you could certainly use as a guidance as to paying down debt versus investing. That's an interesting thought too. But you're getting much more uh,
You
one
That one
off.
step eliminates a
Yeah.
lot of people. Yeah.
Yes, it
I
gets
understand.
very complicated by trying to do that.
Yeah, I get it.
So this is basically my plan. These are my student loan actual numbers here from my interest rate spread. All right, my highest loan was 7.6%. My lowest is 3.76%, and I'm basically going to be doing a avalanche method of paying these things off. Fortunately, I had saved up a chunk while we weren't paying loans, and I paid off the first two immediately upon their accrual of interest. I'm working on the next one down here, the 7% one, so I already paid a chunk off on that one as well. But I'm going to be following this standard kind of avalanche method of going down interest rate, regardless of loan balance. That's the other thing that Dave Ramsey would disagree with is that he
Yeah.
does smallest balance to largest balance.
He does that because he's using a psychology trick, which I greatly disagree with. He's like, "Well, you pay off one, and you're gonna feel great about yourself." It's like, well, just I don't know, have the self discipline to be smart and save the most
Yeah.
money. I don't. I hate that rule.
I paid off two.
Yeah,
Does that make me feel good about coming more? It does, but still, I'm happy to have the two highest interest rate ones off
exactly.
my chart here first. And I actually did separately calculate my interest rate, like my weighted average current rate with my student loans, and it was just over 6%. So definitely going to be a little slog here to get it down below that. The other kind of nuance to the Dave Ramsey approach is that, like I was saying, would tell you not to contribute to your 401k. In my case, I don't have a profit kind of matching or a matching program with my 401k, my retirement from my employer. It's a profit sharing only, so they will make the contribution whether or not I make it. So I did indeed pause that, which gives me another $500 a month to put towards the student loans here, where theoretically I'm achieving a 7% rate of return on that extra $500 a month that I can put there, as opposed to hoping that the market does return on average 10% rate of return over the next 10 years, which based upon the S&P 500 PE is not the most likely scenario right
Yeah.
now.
One thing. So what I did, and granted, this is a very specialized thing because I was lucky enough to have bought a house before a boom, because if you bought a house like 2020 to now, it's pretty wild how much
Yeah.
equity you got. Unfortunately, you can't do a home equity loan right now because interest rates are almost that, essentially. It's like right
No.
there. But as soon as our TLT trade takes off and the interest rates go down, I refinance all of my stuff down to, it was like 2.75 or 3% and put it in the house.
That's amazing. Yeah.
So that part helps.
Yeah. Hindsight, I honestly hadn't really considered it because I bought a home with a decent chunk of like home equity too, and that's my mortgage is under 4%. So it'd been something I would have done at that time, and even then, I was slept at the wheel a little bit too, and I could have done the mortgage, 6 months earlier, and would have been probably closer to a 3.25%.
Yeah. I mean, the other thing you can do is just pay it off with credit cards and then cancel those credit cards. So
Yeah.
once you cancel the credit card, you cancel the debt. I saw that on YouTube, so it's cool.
It was on TikTok. I saw that actually.
It's on
good.
TikTok.
Yeah. Mhm.
All right, guys.
All right, guys. Well, let us know. What are you doing as far as plans to pay off student loan debt? I'm kind of curious on everyone else's thoughts.
Have a good one.